We are the group 16 and we are going to present you portfolio analysis. To begin, we have chosen 10 stocks in the index advertising agencies. The time period of our analysis goes from January 2004 to August 2013. With the software R, we created a matrix containing the data extracted from Yahoo Finance and the variable risk-free from the file FDRF to get the returns of each stock. In this table, we can see all stocks' returns are positives except the stock FULQ. For example, CHWL is preferred to HNTL because of a higher return. It amounts to 2.78%, and a lower variance, it amounts to 3.22%. Here there are the excess return graphs. The first is the excess return of two stocks, HNTL and FULQ. We can see the stock FULQ is more volatile than the other. It's not surprising as it was the riskiest stocks of our portfolio with a variance of 5.81%. The second is the excess return of the portfolio. The index is less volatile than the two stocks because of the diversification. Indeed, it contains more stocks not perfectly positively correlated, permitting also to decrease the non-systematic risk. We remarked then in 2008 the advertising budget of several companies is affected because of the financial crisis and therefore has a negative impact on the advertising sector activities. And now, the next question will be analyzed by Arnaud.
Hi everybody, I will now solve the question 2, 3 steps for the efficient frontier creation. The first step is to compute the global minimal variance portfolio, the JMVP. The JMVP is the portfolio containing our 10 stocks that has the lowest variance. The second step is to target the return. First of all, we have to find the stock with the highest expected return in our portfolio. In this case, this is CHW.L, which is Chime Communications. Then we compute the expected return, the variance and the standard deviation of the efficient portfolio with the highest expected return. To finish, we compute the variance-covariance matrix between the global portfolio with the minimal variance and the efficient portfolio. After running the R code, we obtain the following plot. We can see that the industry index, the big red point, is near the efficient frontier but under the efficient frontier. The index isn't efficient because we can reach a higher expected return with the same level of risk. Gilles will now explain the question 3a.
Thank you, Arnaud. I will now answer, as Arnaud said it, to the question 3a about the efficient frontier with the risk-free rate. Now we include the risk-free rate. Since we have included the risk-free rate, we can therefore compute the tangency portfolio. In order to find it, we have to compute separately a safe and a risk portfolio. Once those are calculated, we just connect them with a solid line. The tangency portfolio is the point on this solid line and is tangent to the efficient frontier. After the R code's writings, we are now able to draw the plot of efficient frontier, including the risk-free rate. We can also notice that the industrial portfolio, the red dot on the next slide, is not efficient because it's under the efficient frontier. Mathieu will now answer to the rest of this question 3 and the last one.
So, hello, my name is Mathieu, and today I'm going to explain our results for the question 3b and 4. So, the question 3b was about the frontier with the market portfolio and the equity weighted portfolio. So, the request was to make a plot of the frontier implied by the market portfolio, so S&P 500 index, and the industrial portfolio. So, the plot shows us that if an investor wants the highest Sharpe ratio, you need to invest in the tangency portfolio. So because the tangency portfolio has the most efficient Sharpe ratio, and a most efficient Sharpe ratio means that the ratio between the difference of the average return and the risk-free and the portfolio variance is the most optimal one. Now we are going to see our results for the question 4 about the capital asset pricing model. So it's relevant to test whether the capital asset pricing model holds in case we use as market portfolio alternatively the industrial portfolio and the S&P 500 index. So we know that the CAPM is a specific single index model relative to the excess return. So you can see on the slides the formula used to express the capital asset pricing model. And after, so we have the details for the expressions of the capital asset pricing model on the slides. And we are able to search the validity of the capital asset pricing model by testing the following hypothesis. So null hypothesis equal 0. So if this is the case, we can say that the CAPM holds. If the alternative hypothesis is different from 0, so we can see that the CAPM does not hold. We can say too about the capital asset pricing model that the beta represents the part of the systematic risk in the total risk of the stock, and L square, as I just said, show the percentage of explicated variations. So now have a look at the results for the CAPM. So in the first case, we use the industrial portfolio as market portfolio. So you can see the results on the slide, and we can see that the p-value of each stock is lower than 5%, which means that the null hypothesis has to be rejected. So we can say that the CAPM does not hold. After we have made the test for the S&P 500 index, and we have obtained the following results. So you can see on the slides the results, and in this case, the S&P 500 index as a market portfolio does yield validation of capital asset pricing model for stocks FuelQ and HNT.L. So this was our results for the question 3B and 4. Thank you for your attention.